Let me now bring on board Neelkant Mishra, Head of Equity Strategy with Credit Suisse. Neelkant, morning. Thank you for joining us. Neelkant, Indian markets have appreciated by 15% plus this year. Foreign institutional investors, they pumped in about 16,000 crore already in this calendar year. So what is fueling this momentum, and why suddenly every institutional investor is liking India again?
Look, this is nothing specific to India. This is something that is happening globally, right from Chinese real estate stocks to the Turkish market to the Mexican currency. I think everything is flying. This is just a risk-on rally, which is being driven by improved liquidity. Liquidity in the second half of last year had been drained out by all the problems that we are aware of in Europe. Now that there is anticipation that the second round of LTRO and possibly a QE3 could actually come in from the Fed, I think the markets are rallying ahead of that. So far, we put this out in a report the week before last. This is a classic mean reversion rally. So the stocks that fell the most have risen the most. And given that there's been very little on the ground to help guide investors in terms of new information or new data points, the only information investors are going ahead with is the prior price performance. And therefore, when we plotted the correlation of the fall in the stocks in the bear market from November 2010 to December 2011 and plotted that against the performance of the stocks since the bottom on 20th December to now, the correlation, the scatter plot, is actually the tightest we've ever seen. So in the last 17 years, all bear market rallies as well as the first stages of bull markets, the scatter plot is never so tight. Which means that there is very little in this other than the mean reversion rally. So far, it is just global liquidity factors which are driving.
Neelkant, if you are of the view that this is a classic mean reversion rally and gains are unlikely to sustain, are you advising your clients that they should use the rally to their advantage and book some profits?
Yes, so what we have said is that, look, beyond a point, liquidity also starts playing a fundamental role, so it does drive fundamentals as well. So there will be companies who have weak balance sheets, or say some banks which need growth capital. They can take advantage of this and raise some capital at good valuations, and that can change fundamentals. So there is some reflexivity angle, and I think the reason why some of the banks, and especially the weaker banks, are running up as well is also because of that if this rally continues, and as it is expected that the second round of LTRO can lead to an even stronger rally, some of these banks can actually change their fundamental aspects as well. But at the same time, any amount of liquidity that you can throw into the market is not going to change the situation, say, on the coal side. So liquidity cannot drive coal supplies, for example. And therefore, on power equipment, on some of the utilities themselves, and just because the stocks are going up doesn't mean that they will be able to raise, rather be able to issue primary equity. So we are advising that some stocks which are going up in this mean reversion rally and actually have very little chance of seeing any fundamental improvement, whatever happens to liquidity, I think those should be sold off. And some of the power equipment names which also disappointed on results were stocks where some differentiation has already started. I would have also flagged some steel names, etc., where the demand-supply situation is actually is going to worsen quite significantly in the coming year.
Neelkant, how critical could be the upcoming UP elections as well as the budget this time around be as a catalyst for the momentum that the market is currently seeing?
Right, so let's start with the budget. I think the budget is going to be a very important event this year. In the last, several years, the budget was just what a budget should be. It wasn't really a policy document. The introduction of reforms, and the reason why, say, in the late 90s, early parts of last decade, we used to look forward to the budget to see what reforms were being undertaken. I think that was not the case in the last several years. This time, of course, I think it will be a very important budget, given that the fiscal deficit in FY12 is likely to be quite high. And the challenge for the government will be how to deal with the deficit in FY13, because that's the year in which you will see almost a full year of weak revenues, meaning tax revenues. And the balancing of fiscal consolidation versus growth, because as a policy you can take an approach that I will grow out of the deficit. And I can keep the expenditure the same, but I can somehow tweak the numbers so that I can catalyze growth. To the extent to which the finance minister is able to deliver, at least on the face of it, a lower fiscal deficit target for FY13 will be very important. So if he is able to show a sub 4.5% say a fiscal deficit target, which will mean that the borrowing number remains mostly unchanged year on year, then well, at least in theory the Reserve Bank will be in a position to start easing on the monetary side in case inflation does come down. Otherwise, I think they'll have no justification for doing that. On the UP elections, I think the market is just more or less convinced itself that what I think is one of the several outcomes, which is the Congress and the SP coming together and forming a government, Congress being a subordinate partner, and therefore the SP with its 22 seats in the central government and the Lok Sabha and start supporting it. I mean, that's one of the various possibilities, and the market seems to be convinced that that is the only possibility. So even if there was to be such an outcome, I don't think the market will be surprised positively. But I see quite a strong likelihood of the opposition doing better because of this being a four-way fight and a lot of strategies being used to cut votes of other parties, etc. So there could be some consolidation in the favor of opposition, and there could be a surprise in terms of numbers. I still don't see there being one party winning an absolute majority, but I think the seat shares that are being talked about also could be widely different from what is believed. So I think the UP elections, either which way, I think are unlikely to show a positive surprise, and I think there is a reasonable chance of them surprising negatively in terms of the mandate in favor of the Congress.
Let's just take a detour, and large cap stocks are looking slightly toppy, but there is plenty of momentum in the small stroke mid cap and the semi large cap names. Two stocks which I would like to point out, both from the PSU space. One is BEML, that is Bharat Earth Movers Limited. It's official now that Reliance Mutual Fund owns 5% stake in the company, and the other one is BEL, PSU company based out of Bangalore. Niche player, 1450, up about 21 rupees. Nilkant, fair point that in the near term market is always a function of demand and supply, but risk versus reward. Let's divide the market into two parts. Which end of the market to your mind is still in the green zone, and which end of the market to your mind is now approaching the hot zone, the red zone?
I would still say that fundamentally nothing has changed. I know our market call, which was a negative call, has not worked and actually has been very wrong so far this year. But fundamentally, I see nothing changing on the ground. I mean, I don't see any major policy moves in the government. I don't see any major pickup in demand segments. When a lot of what we hear is hope and optimism, but there is absolutely nothing that is there on the ground. Even inflation, which has come down, is most likely to flare up again in March. And given the amount of OMO that the Reserve Bank is being forced to do, I don't think inflation is going to come down meaningfully as well. So nothing absolutely has changed fundamentally. So this is a mean reversion rally, and these rallies have happened in the past. In the last, since 95, we have seen, I think, 16 mean reversion rallies, or other bear market rallies, which have driven performance of 9 to 28% and lasted 12 to 70 days. This one, in terms of duration, is already among the longer ones. In terms of magnitude, it's right in the middle. So each of these rallies, of these 16 rallies, has petered out, and the market has had hit fresh lows. So long as this, I think it's a very tricky call. How long does this liquidity rally continue? But so long as it continues, all the stocks that are beaten down will keep going up. But whenever this liquidity surge gets over, I think all that has gone up will come down as well. There will be some stocks which, and if this lasts long enough, will be able to, say, repair their balance sheets, who are in the vicious cycle of high debt. So once we start seeing primary issuances, with the companies taking advantage of this liquidity to raise and repair balance sheets or get cheap growth capital, I think those would be stocks where you would not see them hitting the lows that they did, say, on December 20th. But otherwise, all that has gone up has to come down. Because unless things change on the ground, and this is something again that we have tried to analyze, there is this widely held belief that foreign flows drive the Indian market. I think they do. India is a capital deprived economy, but a deficient economy, and therefore foreign capital is always welcome. But beyond the 2003-2010 phase, the correlation between foreign flows and the market performance is absolutely not there. It's 12%. Just flows will not drive the market, and flows do not change fundamentals except for select things that I just discussed. And therefore, the red zone, as you mentioned, would be all the stocks that have gone up.
So Neelkant, just purely on a valuation parameter, how much more headroom does the market have? 5%, 10%?
Hard to say that. On the valuation basis, given that bond yields, which you can use as one parameter, typically bond yields and earnings yield should be not the same, but in the same ballpark. And bond yields are still 8% plus, and they're being supported there by very aggressive open market operations of RBI. The moment they stop doing it, my fear is the yields start flaring up again, and the justified multiple starts coming down. So, as I said, people want to buy, and the people who are left out are trying to buy more. And therefore the mid caps and the small caps are rallying because you want to make up for the underperformance, and it's very disturbing when the first 3 or 4 weeks of the year you've underperformed by 4 or 5%, 6%. So people are trying to catch up on that, and so I don't think there is any valuation driven benchmark where you will start seeing a correction.
Neelkant, I don't want to get this one wrong because we will be flashing your remarks now. Are you sending a message across that the current rally is more like a suckers rally, it will not sustain, and it's a matter of maybe months or weeks, Nifty will go back to 4,500 or even 4,000?
I would not use harsh phrases like suckers rally, because this is a global liquidity driven rally, and developed and large and developed economies are, I think, in a game of competitive devaluation of their currencies. So both Europe and the US want cheaper and cheaper currencies. And at some point of time, that will show up in inflation numbers in emerging economies. It will show up in also higher risk assets. My view is not that this is really a suckers rally, but what I do think is that eventually fundamentals will matter, and the markets will start showing the weaker fundamentals that India has. It's hard for me to say if market really goes back to 4,500 or not, but I do see meaningful downside from current levels, because all that has gone up, there's absolutely nothing driving it in terms of fundamentals.